Datavault AI Inc., trading under the ticker symbol DVLT on the Nasdaq, is showing a live intraday stock price of $0.51 per share during active trading on Wednesday, June 3, 2026. This represents a modest intraday gain of 1.40% over the previous market session. While a sub-dollar price point often scares off institutional players and makes casual observers view the company as just another highly volatile penny stock, the raw market numbers mask a massive gap between public perception and operational scale. Most retail investors watching Datavault AI stock look at the historical long-term chart, see a downtrending line from its legacy days, and assume it is a dying entity. However, the unexpected twist hitting the market right now is a massive pipeline of real-world asset tokenization programs worth hundreds of millions of dollars, completely flipping the script on what this business actually produces. Just yesterday, the company finalized a major execution agreement to list over $328 million in physical commodity token programs on a regulated exchange platform. This move directly addresses a multi-trillion-dollar institutional framework, transforming what people thought was a struggling small-cap stock into a functional digital infrastructure play. The common consensus surrounding this stock is built on an old narrative. People see the name changes, shifting from Summit Semiconductor to WISA Technologies and finally to Datavault AI Inc., and assume it is a business without an identity, drifting from one hot tech buzzword to another. The general belief is that this is an unprofitable microcap diluting its way through a difficult operational environment. However, a deeper analysis forces a critical reassessment. When you peel back the layers, the reality is that the company has actively accumulated a massive, globally protected intellectual property portfolio, spanning more than 20 issued and pending patents. They are positioning themselves as a core data clearinghouse, where unstructured enterprise data gets scored, priced, and turned into liquid capital. Mainstream investment sites often miss these microcap transitions because they rely strictly on backward-looking financial screens. But watching the volume spikes and institutional interest tells a very different story about where the smart money is paying attention. To truly understand the modern price action of Datavault AI stock, we have to look closely at the massive trading volumes and recent daily swings that have defined the stock over the past few weeks. The average trading volume has ballooned to over 54 million shares, an astronomical number for a company with a market capitalization sitting around $431 million to $476 million, depending on daily fluctuations. This incredible liquidity means there is an intense battle occurring between short sellers betting on structural failure and speculative buyers accumulating shares at what they believe is a deep cyclical bottom. Institutional activity has begun to show quiet accumulation patterns, particularly following the company's aggressive moves to secure structured financing. Earlier this week, the management team signed a massive non-binding term sheet for a potential $2 billion structured financing facility with an exclusive global tokenization mandate. A multi-billion-dollar financing arrangement for a company with a share price of 51 cents creates an immense amount of structural friction between what the market is pricing in and what the corporate actions imply. When you look at macro pressures, the stock is operating in an environment where high-performance computing and secure data sovereignty are commanding massive premiums, while giant tech names like Nvidia stock or Apple stock dominate the headlines and suck up the capital in an individual brokerage account. Small-cap data management platforms are where the asymmetrical risk-to-reward profiles are being formed. The latest earnings report revealed that the business brought in roughly $41.88 million in revenue against a cost of revenue of $11.43 million, yielding a very healthy gross profit of over $30.4 million. However, the bottom-line net earnings showed a loss of $122 million due to massive non-recurring expenses, structural integration costs, and aggressive spending on research and development, which climbed to $5.73 million in the most recent quarter. This net loss is the primary reason why short-term traders using basic online investing apps dump the stock, while long-term strategists see a high gross margin software model waiting to outgrow its upfront corporate overhead. Let us pivot slightly to address what this business actually does at its fundamental level. Founded originally in 2010 and operating out of Beaverton, Oregon, the company built its foundations on high-end wireless audio and data transmission standards, holding the industry-standard WISA technology, which enables high-definition, multi-channel wireless sound. But the massive structural pivot occurred when it completed an asset purchase from privately held Datavault Holdings at the end of 2024. By integrating these enterprise-grade artificial intelligence agents, branded as Datavault, Data Value, Data Score, and Datavault Bank, the company created a hybrid business model. It allows corporations to take massive, unutilized data pools, clean them, assess their true market value through an alliance with corporate systems like IBM's Watson's, and securely monetize them. They also operate a blockchain-based academic credentialing and verification network called VerifyU, along with their ADO platform, which transmits data over ultrasonic sound waves. They are essentially a data quarterback, operating at the intersection of traditional hardware, enterprise data analytics, and digital asset ledger systems. This brings us to a major inflection point for investors utilizing platforms like Robinhood Stock Trading, SoFi Invest, or Interactive Brokers Trading to build out speculative growth portfolios. If you look at standard self-investing strategies on popular investing sites, the general guidance is to avoid companies with large trailing net losses. But the company recently reiterated its full-year corporate revenue guidance, maintaining a target of at least $200 million for the year. If they successfully execute on this target, it would represent a massive 400% year-over-year revenue growth rate. For a stock trading at 51 cents, a verified 400% top-line growth rate creates an extreme imbalance in valuation metrics. If the market begins to price the stock based on its forward revenue targets rather than its legacy net losses, the current capital structure will look completely different 12 months from now. Comment below how many shares of Datavault AI stock you currently hold, or if you are keeping it on your watch list. Looking forward, the future outlook for the stock relies on 3 distinct operational scenarios. In the best-case scenario, the phased rollouts of their real-world asset tokenization programs, starting with the MTB Copper project on the Perpetuals exchange, will validate their ability to generate massive transaction-based recurring fees. If these programs scale effectively across their broader portfolio of gold, zinc, and strategic minerals, the corporate cash flow will pivot to positive much faster than Wall Street analysts currently project. The primary risk factor is execution and dilution. With 855 million shares outstanding and a history of utilizing equity markets to fund operations, any delays in finalizing that $2 billion structured financing term sheet could force the company to issue more shares, capping short-term upside for retail accounts holding the asset on a basic online investment platform. To map this out clearly, investors using premium tools like the Interactive Brokers platform, specialized Fidelity ETFs, or automated portfolios through Schwab Intelligent Portfolios need to look at the massive gap between the market narrative and the operational reality. The expectation priced into the current 51-cent stock price is that Datavault AI is a complex, cash-burning tech company struggling to find its footing after multiple corporate rebrands. The reality, however, is an asset-rich corporate entity with over 20 core global patents, a projected $200 million forward revenue run rate, an active data partnership with enterprise giants, and an immediate $328 million pipeline of listed digital commodity assets. When a company's underlying infrastructure begins to scale faster than its public market equity valuation, the tension between what investors expect and what the balance sheet actually delivers inevitably snaps. Whether management can cleanly execute without further capital dilution is the ultimate question, but writing off this digital infrastructure play as a simple penny stock completely ignores the massive structural wheels turning behind the scenes. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.